good morning, traders. And certainly yesterday, the focus was very much on the FOMC preview and what was going to happen or what potentially could happen in the meeting and what could be the trades to see from that. Now, one of the views we had taken out was that given relative to market positioning and expectations, which had been building to a more hawkish turn, given the fact that we'd seen the likes of Lael Brainard really ratchet up their views and saying that we could take the Fed funds rate above the neutral rate, or the short-term neutral rate. And certainly expectations had been building for a hawkish turn, and therefore we had seen a situation where we could see a bid in US Treasuries. The US dollar could see a bit of downside on the back of that. Now, we have seen that playing out reasonably well. I'm fairly happy with my US Treasury calls. We'd seen good buying in the belly of the curve, 5 to 7 years, finding good buyers through there. The 10-year dropped 4 basis points. We're seeing that trading at 305 at the moment. And we are seeing a flattening of the yield curve as well. And I continue to see that trading through sort of 20 basis points in the short term. And potentially over the next 6 months, there is real scope now for an inverted yield curve as we look at difference between 2s and 10s. In terms of the dollar, well, that, of course, trading around announcements is always going to be very tough. You've got stops, you've got liquidity, obviously, always a factor. And the US dollar index was pretty scatty. It dropped initially after the Fed removed their accommodative setting, which shouldn't really surprise. If you look at the Fed funds rate, which now sits in a range of 2% to 2.25%, let's call it 2.125%, for example. Now, if you adjust that for the Fed's preferred inflation measure, which of course is core PCE, we have now a positive real Fed funds rate of about 26 basis points. So there's really no reason for the Federal Reserve to hold an accommodative stance on monetary settings. That is getting closer towards a more neutral setting, but it's of course miles away from being restrictive, and that will happen when they go firmly through the neutral rate, which of course is some way away from where it is at the moment. But there's no reason for the Fed to have an accommodative setting. But we did see the US dollar initially sell off on that. We saw the euro dollar pushing up into that 118 handle. We saw Aussie dollar moving above 73 cents. It got up to around 73.15 or so, and then we saw a bit of a reversal. Actually, if you have a look at the daily chart of Aussie dollar, you can see a fairly pronounced doji pattern, which suggests that we do see a lower low coming through in today, that the sellers will try if that proves probably through 72 cents. Definitely a trade to have on your radar there. But if you look at the economic projections from a more holistic view, we do know that the Fed are very comfortable with where they are. They'll be sitting there patting themselves on the back, thinking that they've done a pretty good job. Their views for the dot plot projections for 2018 seem to be coming out pretty well. They're calling for 3 rate hikes in the year ahead, and I think the market is still fairly pessimistic on that view. But there's every reason to believe that if we do get a fiscal stimulus coming through from the Trump administration, of course that's a big if now, that considering as we could see a split Congress in November, that we are going to see another 3 rate hikes in 2019, probably another one in 2020, and then 2021, which is we got their projections for the first time. We probably won't get any rate hikes in there if you look at their medium estimate. Now, if you actually look at the distributions of dot plots for there, where each individual Fed member gives their view on where monetary policy settings are going to be in that period, there's a massive debate going on within the Federal Reserve. You've got one member calling for well over 4% Fed funds rate, and then you've got another member, I suspect that to be Jamie Bullard, calling for that to be around 2.5%. So there's around a two percentage point divergence in where they see the Fed funds rate going to be in 2021. That leads me to believe that there's going to be high volatility in the years ahead, especially when we marry that up with a more normal balance sheet from the Federal Reserve, which of course is contracting. And there are signs that in the years ahead they may actually have to stop that balance sheet normalisation. But if we do have a look at the moves in markets overnight, very much driven by what's happening in the rate structures, very much driven by what's happening in the fixed income space. We are seeing that as relative to market expectations, somewhat more dovish. How the dollar trades going forward, I think, is still very much going to be data dependent. And of course, the Federal Reserve can increase that scope from 3 rate hikes up to 4 rate hikes if the inflation numbers do start kicking on. And of course, we still haven't factored in tariffs into that situation as well. And of course, we haven't got enough information around that. That'll probably come in the December meeting. But at the moment, I think the wash up from this is if you look at the fixed income market, if you look at the dollar against the yen specifically, you are seeing relative to those lofty expectations, probably just a repositioning coming through. But of course, the Fed, while sitting happy at the moment, they feel they're on the right projection, the right trajectory to where they see a more normal economy going forward.